Welcome everyone. Today we are going to explore some powerful tools that traders use to get a better idea of what the stock market might do next. We are talking about chart patterns. Whether you are a beginner or you have already dipped your toes into trading, by the end of this session, you will know some of the key chart patterns to watch out for. These patterns can be your signals that prices may soon move, and they will help you make smarter decisions when you trade. Ready to jump in? Let us start by getting a sense of what chart patterns are and why they matter. So, what exactly are chart patterns? Well, simply put, they are shapes that pop up on stock market charts because of how prices move. And these shapes can tell you a lot. They can help predict where the price is headed next. Imagine you are driving and you see signs on the road telling you when to turn or when to slow down. Chart patterns are kind of like those signs, except they are for stock prices. If you know what to look for, you can decide when it is a good time to buy, sell, or hold. That is why learning these patterns can make a big difference for you. Let us start with the first type of patterns you will want to know about. These are called reversal patterns, and they are all about telling you when the price is about to change direction. A really well-known reversal pattern is called the head and shoulders pattern. It looks like a head in the middle with two shoulders on either side. Picture a tall peak between two smaller peaks, and that is your head and shoulders. If you see this shape forming, it usually means that the price might change direction and start going down. It is like a warning sign that things could be turning around. To understand it better, imagine the head and shoulders as a battle between buyers and sellers. The left shoulder forms when the price rises and then pulls back. Then buyers push the price even higher to create the head, but after that, the price falls again. Finally, there is another attempt by the buyers to push the price up, but they cannot reach the height of the head, and that forms the right shoulder. This shows that buyers are losing strength each time, and sellers are beginning to take over. The more times the price fails to break through these peaks, the more likely it is that the trend will reverse. A key part of this pattern is something called the neckline. The neckline is formed by drawing a line that connects the lowest points of the dips between the head and the shoulders. When the price drops below that neckline, it usually confirms that the trend is reversing. This break below the neckline is often seen as the point where the sellers take control, and it can be a strong signal that the price is likely to keep moving downward. The steeper the neckline, the stronger the potential move downward can be. Traders also pay attention to the volume when the price approaches the neckline. A significant increase in volume during the breakout is a good confirmation that the reversal is real. Without enough volume, the breakout might not be reliable, and the price could end up moving back up again. So, watching the volume is an important step in making sure that the pattern is valid. Now, there is also something called an inverse head and shoulders pattern, and this one works the opposite way. Imagine the same shape, but upside down, with two troughs on either side of a deeper trough in the middle. Instead of the price going down, this pattern tells us that a downward trend might be reversing into an upward trend. To understand the inverse head and shoulders better, think of it as the market testing a support level multiple times. The left shoulder forms when the price falls and then rises slightly, showing that buyers are starting to step in. Then the price drops again to create the head, which is the lowest point, showing that sellers still have some control. However, when the price rises again from that low point, it shows that buyers are coming in even stronger. Finally, the right shoulder forms as the price dips one more time, but this dip is not as deep as the head, showing that the sellers are losing strength. Once the price moves above the neckline, which is the line that connects the highest points of the two rebounds, it is often seen as confirmation that the trend is reversing. The neckline here is critical because it represents a level of resistance that the price has struggled to break through. When the price finally moves above it, it is a strong sign that the buyers have taken control and that the price could continue moving up. Traders also look for an increase in volume as the price breaks above the neckline. This increase in volume confirms that there is real momentum behind the move, making it more likely that the reversal is genuine. Without sufficient volume, the breakout might not hold, and the price could fall back below the neckline. When you see an inverse head and shoulders with a strong breakout and high volume, it could be a good time to think about buying, as it signals a potential upward move. There are other reversal patterns too. Let us talk about the double top and double bottom. A double top happens when the price reaches a high point, drops a bit, and then reaches that high point again. It almost looks like the letter M. This usually means that the price is struggling to go any higher and it might start dropping. On the other side, there is the double bottom. This looks like the letter W, and it signals that the price has hit a low point twice and could start climbing up again. There is also the triple top and triple bottom. These work similarly to the double top and bottom, except the price peaks or hits a low point 3 times instead of 2. When you see this, it often means that there is a strong chance the price will reverse. Triple tops and bottoms are usually a bit more reliable than doubles because it shows that the price has tried even more times to break through, but it just could not. These patterns are relatively common, especially in longer time frames where the price has more opportunity to establish multiple highs or lows. A triple top forms when the price reaches a peak level 3 times, with each attempt to move higher being rejected at around the same price point. This suggests that the resistance at that level is very strong, and each time the price tries to break through, it fails, indicating weakening momentum among buyers. Similarly, a triple bottom occurs when the price falls to a similar level 3 times and then bounces back, showing strong support at that level and a lack of momentum from sellers. You might see these patterns in various market conditions, especially when an asset has been moving sideways for an extended period. They are most likely to show up after a strong trend, followed by a period of consolidation where neither buyers nor sellers are in control. For traders, it is crucial to wait for confirmation before acting on these patterns. In the case of a triple top, confirmation comes when the price breaks below the support level that was formed after each peak. For a triple bottom, confirmation is when the price breaks above the resistance level formed during each rebound. Volume plays an important role in confirming these patterns. For a triple top, a decrease in volume as the price approaches the 3rd peak is a signal that buyers are losing strength. When the price finally breaks below support, a spike in volume can confirm that sellers are taking control. For a triple bottom, rising volume as the price moves up from the 3rd trough suggests that buyers are stepping in strongly, and a breakout above resistance with high volume confirms the reversal. When dealing with triple tops and bottoms, it is important to remain patient and wait for that final confirmation before making any trades. Acting too soon could result in getting caught in a false breakout, where the price briefly moves beyond the support or resistance levels but quickly reverses. By waiting for solid confirmation with increased volume, traders can increase their chances of successfully trading these patterns. Okay, now that we have covered some of the major reversal patterns, let us move on to continuation patterns. These are patterns that tell you the current trend is likely to continue. One of the most common continuation patterns is the triangle. You might see a triangle forming on the chart when prices are moving. There are three main kinds of triangles: symmetrical, ascending, and descending. A symmetrical triangle happens when the price is kind of stuck, moving up and down in a narrowing range, almost as if it is getting compressed. Imagine a spring being squeezed tighter and tighter, storing potential energy until it is ready to explode in one direction. This is what happens with the price as it gets squeezed between the converging trend lines that form the triangle. You can visualize the triangle shape forming as each swing in the price becomes smaller, creating a pattern of lower highs and higher lows that slowly move closer together. This kind of pattern suggests that the market is undecided, with neither the buyers nor the sellers being able to fully take control. The price is getting ready to make a significant move, but it is hard to predict which way it will go until it breaks out of the triangle. It is like watching a tug of war where neither side is winning, and the rope is stuck in the middle until suddenly one side gives way. The key here is to be prepared for either outcome. You need to keep an eye on the trend lines that make up the triangle. When the price breaks above the upper trend line, it signals that the buyers have taken control, and the price may continue moving up. If the price breaks below the lower trend line, it means the sellers have gained strength, and the price could continue downward. Traders often wait for a strong breakout confirmed by increased volume to make sure the move is genuine and not just a false breakout. A breakout with low volume might mean that the move will not hold and the price could return inside the triangle. So it is important to watch closely and be ready to act when the breakout happens. The ascending triangle is different because it shows higher lows, but the resistance or the top part of the triangle is flat. This usually means the buyers are gaining strength and the price will likely break out upwards. Imagine trying to push open a door, and each time you push, you get a little stronger. Eventually, that door is going to fly open, and that is what happens with an ascending triangle. Then there is the descending triangle, which is essentially the opposite of the ascending triangle. In this pattern, the highs are getting progressively lower while the support level remains flat at the bottom, almost as if there is an invisible floor that keeps catching the price each time it falls. This visual tells us that sellers are becoming more aggressive, consistently pushing the price lower, while buyers are struggling to hold the line at the same support level. Picture a ball bouncing against a solid floor, but with each bounce, it does not go as high as before. Eventually, the ball runs out of energy and breaks through the floor. In the case of a descending triangle, the price keeps getting pushed down to the support level by the sellers, and once the support finally gives way, the price is likely to break downward sharply. This means that the sellers are taking control of the market, and it suggests that the downward pressure is about to increase. Descending triangles are common in markets that are already trending downward, often appearing during a period of consolidation. They act as a continuation pattern, meaning that if the market is already moving down, the descending triangle signals that this downward movement is likely to continue. Traders watch for a strong breakout below the support level as confirmation that the price is continuing in that direction. To trade a descending triangle effectively, it is important to wait for a clear breakdown below the support line, ideally with increased volume. The increase in volume acts as a confirmation that the sellers are fully in control and that the breakout is likely to be sustained. If the breakdown occurs without sufficient volume, there is a chance it could be a false breakout, and the price could move back up into the triangle. So, watching the volume and being patient are key when dealing with this pattern. If you are a trader looking to capitalize on a descending triangle, setting a stop loss just above the most recent lower high can help manage your risk. This way, if the breakout turns out to be false, your losses are minimized. Once the price breaks below the support, many traders look for opportunities to enter a short position, expecting the price to continue falling. Another continuation pattern is called the flag or pennant. A flag looks like a small rectangle that forms after a strong price move, kind of like a flag waving on a pole. The price takes a little pause to catch its breath before continuing in the same direction. A pennant is similar, but instead of a rectangle, it looks like a small triangle. Both of these patterns mean that the trend will likely keep going in the same direction after a short break. Let us talk about wedges now. A wedge can be rising or falling. A rising wedge slopes up, but it actually signals that the price could soon reverse and go down. On the other hand, a falling wedge slopes down, but it suggests that the price might reverse and move up. Wedges are a bit tricky, but they are worth paying attention to because they can give you some great signals about what might happen next. Next, let us talk about bilateral patterns. These are patterns that can go either way. They can signal a continuation or a reversal. One common bilateral pattern is called a rectangle. Imagine a ball bouncing back and forth between the floor and the ceiling. The floor is the support level, and the ceiling is the resistance level. The price keeps moving up and down within these two levels, almost as if it is trapped inside a box. The rectangle pattern forms because neither the buyers nor the sellers are strong enough to push the price out of this range. It keeps bouncing between the top and bottom until it eventually breaks out in one direction. This breakout can happen either upwards or downwards, which is why it is called a bilateral pattern. It can signal a continuation of the current trend or a complete reversal, depending on which way the breakout goes. The key to trading a rectangle is patience. You need to wait and see which side gives way before making your move. If the price breaks above the resistance level with strong volume, it often means the buyers have taken control, and the price will likely continue to rise. If the price breaks below the support level, it shows that the sellers are in control, and the price could continue to fall. This pattern can show up in all kinds of market conditions, but it is especially common when the market is in a consolidation phase, where there is no clear trend. Traders use these patterns to spot potential opportunities, but it is crucial to wait for a confirmed breakout with significant volume to avoid getting caught in a false move. Visualize it like waiting for that ball to either break through the ceiling or crash through the floor. Only then do you take action. Another bilateral pattern is the diamond pattern. This one starts wide and then narrows, and it can also signal either a continuation or a reversal. The key is to watch which way the price breaks once the pattern finishes forming. It can be tricky, but it is a pattern that experienced traders like to watch for. Now that we have gone over the major chart patterns, let us move on to something called candlestick patterns. These patterns give you a lot of information just by looking at a single candle or a couple of candles on a chart. A common candlestick pattern is called a doji. Imagine a moment when the market is holding its breath. A doji forms when the opening and closing prices are almost the same, leaving a shape that looks like a cross or a plus sign. It is like a pause, signaling that the market is undecided and neither side has the upper hand. Picture it as a tug of war where both teams have equal strength, and the rope is just hanging in the middle. When you see a doji, it is telling you that neither the buyers nor the sellers are in control, creating a point of balance that could lead to either a continuation of the current trend or a reversal. It is almost as if the market is at a crossroads, waiting to decide which path to take next. Traders often pay close attention to what happens after a doji because it can be the turning point for the market. If you see a doji during a strong trend, it might suggest that the trend is losing momentum, while a doji in a quiet market could be a sign that big movements are on the horizon. Next, we have the hammer and the inverted hammer patterns. A hammer looks like a small body with a long lower wick, kind of like a hanging hammer. It forms after a downtrend and signals that buyers are stepping in and that a reversal could be on the horizon. The inverted hammer is similar but upside down, and it often signals a reversal after a downtrend as well. Engulfing patterns are also important to know. A bullish engulfing pattern happens when a small red candle is followed by a larger green candle that completely engulfs the previous one. This usually means that the price is about to reverse to the upside, and it can be a strong signal to buy. A bearish engulfing pattern is the opposite. It is a small green candle followed by a larger red candle, which signals that the price is about to reverse to the downside. But how can we confirm these patterns before taking action? One of the best ways to confirm a chart pattern is by looking at the volume. If the price breaks out of a pattern with high volume, that is a good sign that the move is strong and reliable. On the other hand, if the breakout happens with low volume, it might not be as reliable, and the price could go back to where it was. Using indicators like moving averages or the relative strength index can also help confirm whether a pattern is likely to play out. These indicators are like extra tools in your toolbox. If they support what the pattern is telling you, it gives you more confidence in your decision. Now that we know about confirming patterns, let us talk about some common mistakes people make when reading chart patterns. One common mistake is trying to force patterns that are not really there. It is easy to look at a chart and convince yourself you are seeing a pattern because you want to see it. But it is important to let the chart tell you what is happening instead of trying to make it fit into a specific shape. Another mistake is ignoring confirmation. It is really important to wait for the price to confirm the pattern before you act on it. If you jump in too quickly, you might get caught in a false move. A breakout with low volume might not be reliable, so it is better to wait until you have a clear signal. False breakouts are another thing to watch out for. These happen when the price breaks out of a pattern briefly, but then goes back inside. It is like a fake move that tricks traders into acting too soon. To avoid getting caught in a false breakout, always wait for strong confirmation before making your move. Now, if you are just starting out, here are a few practical tips that will help you. Focus on learning a few basic patterns first, like the head and shoulders, triangles, and flags. These are some of the most common patterns, and they will give you a solid foundation to build on. Once you get comfortable spotting these, you can move on to more advanced patterns. Another great tip is to practice by tracking patterns in real time. Keep a list of stocks or assets that you want to watch and try to spot the patterns we talked about. Keep track of how often they appear and what happens after the pattern forms. This will help you get better at recognizing them in the future. And finally, practice with a simulated account or by paper trading. This lets you identify and trade patterns without risking real money. It is a great way to build your confidence before you start trading live. To sum it all up, Chart patterns are very useful tools for predicting where prices might go next. We talked about reversal patterns like the head and shoulders, continuation patterns like triangles, and candlestick patterns like the hammer. The most important thing is to always confirm what you see before making a move. Use volume and other indicators to help you decide if the pattern is real and worth acting on. Learning how to read these patterns takes time, but with practice, you will get the hang of it. Keep practicing, stay patient, and you will be spotting patterns with confidence in no time. Thanks for joining me today, and I wish you the best on your trading journey. If you have any questions or thoughts about what we discussed, I would love to hear from you. Keep learning, keep practicing, and good luck out there.